Hi, good morning, all of you. Great to have you here for our webinar titled GCC Markets, an Attractive Emerging Market Allocation Play. It's a very interesting theme since GCC markets have become part of Emerging Market Index. There's a lot of buzz around this topic, so we thought we'll give it a specific focus and try to glean some insights and present it to you. We have fairly an interesting agenda before us. We will, of course, get into the GCC part of MSCI Emerging Market Index and what does it take to get into the index and how things move out of the index and what type of stocks are present and how do we see the present and more importantly, how do we see the future in terms of the evolution of these GCC markets into the MSCI Emerging Market Index. So let me jump to the first part, which probably is very interesting to understand how MSCI includes some countries into their list. Mainly, there are three stages. As you can see, they start with shortlisting a country, and then they eventually announce a decision, and finally they include them in the index. So this is basically a 3-year process, and the first GCC countries that were included was back in 2013 when MSCI upgraded UAE and Qatar from frontier to emerging markets, and in 2014 these two markets were the first to get into the index, and then it was followed by Saudi Arabia in 2019 and Kuwait in 2020. So we have now 4 GCC markets that are part of the MSCI market index, and we can see the split here. Cumulatively, they are about 7.3% of weight in the MSCI Emerging Market Index with about 70 stocks. Obviously, Saudi Arabia has an overbearing presence in this list. Saudi's weight is about 4%, 4.2 to be precise, with about 40 stocks. So even if you look at the top 10 GCC stocks in the EM index by weight, we see the dominance of Saudi Arabia through and through. Half of the top 10 is from Saudi Arabia, and then we have 2 Kuwaiti stocks, NBK and KFH, and then we have UAE and Qatar as well represented in this list. In terms of sector contribution of GCC stocks, obviously banking and financials have a lion's share. This is probably the structure at a market cap level for these markets as well. So financials are highly represented in this sectoral allocation at about 53%, followed by materials and telecom. So that's the sort of weight, and shortly we'll see how does that compare to the overall EM structure, which is given here. If you look at the EM structure, it is dominated by China. China has a weight of about 28.5%, represented by nearly 500 stocks. The entire MSCI EM index has about 1,377 stocks. So in that context, Chinese weight as well as number of companies are really very dominant. This is followed by Taiwan with a weight of 14.5%, represented by about 114 countries, and then India and Korea. And then GCC comes as the 5th, the dominant block in this table with about 70 stocks. But the key point to note here is the sectoral distribution of EM index is dominated by, of course, financials, but not as heavily as GCC. And then we have a significant information technology aspect of EM, which is not present in the GCC. So that's where the sectoral difference between the broader EM index and the GCC part can provide some excellent diversification avenues for investors. Coming back to EM index, it's dominated by Taiwan and China, and to an extent India. In the top 10, we can see China dominating through and through, but the Taiwanese firm, Taiwan Semiconductor, has the largest weight of about 6.2% in the index, which is quite significant. And then we have, quickly, if you drop down the list in the top 10, you will see that it settles down to around 1% for these stocks. So in that context, the Taiwanese share is quite high in the top list. It's also very interesting to see how when GCC Markets became part of the EM index, as I said, there are three phases to the whole thing. First, you have the shortlist phase, which is the dark blue that you see here. And then you have the decision phase, which is the light blue. And then you have the eventual inclusion, which is the dark orange. And then what happens 1 year post-inclusion and 3 year post-inclusion. So there is a lot of anticipation trade that we can see here. Before the inclusion itself, the interest starts building up for these markets and for these stocks. And eventually, they either go on to perform very well in the next 1-3 years, or they sort of a tapper based on the company's performance in the stock exchange. But the pattern is very repeatable, as we can see for Kuwait and for Saudi Arabia and for UAE and for Qatar. So all this we have looked at from an index point of view as well as from the stock point of view. So it's more of anticipation interest that is very predominant in this type of pattern that we see. Eventually, inclusion in the index will also bring in a lot of foreign flows to these markets. But again, there are foreign flows even in anticipation of the inclusion. So if you take Kuwait, for example, Kuwait was actually shortlisted for inclusion in 2018, and you see some small flows. And then in 2019, the actual decision was made. So you see the flows there as well. And eventually in 2020, it was included. But 2020 being a COVID year, obviously there is some fall in the foreign flows. But it again picked up very well in 2021 and 22. The same pattern can be observed for Saudi Arabia, actually. In fact, again, we see a small dip in 2020 because of COVID, but after that, we see some rapid foreign flows into these markets. So obviously, countries hope to get included in these indices because it attracts a lot of foreign flows, as you can see here. At a stock level also, this is very clear. For example, NBK back in 2018 had a foreign ownership of about 10%, which is now about 25%. So that's the ramp up in foreign ownership that we see across three phases, which is the shortlist phase, the decision-making phase, and the inclusion phase. Every stock that we have highlighted here, be it Gulf Bank or KFH or Mobian Bank, have experienced some significant increase in foreign ownership. We can observe the same for UAE stocks as well. Most notably, we can see that First Abu Dhabi Bank has increased from 12% to nearly 18%, while one stock, which is Al Dar Properties, actually reduced from 26% to 20%. But barring that, you can see the trend generally is one of increase in terms of foreign ownership. Now, some insights about what really it takes for MSCI to include or exclude a market. Obviously, they operate at three levels. One is that they look at the economic side of the story. Then they look at the size and liquidity requirements, and also market accessibility criteria. And these criteria are very clearly laid out for frontier markets, emerging markets, and developed markets. Of course, from a market accessibility criteria point of view, the requirements are extremely high for developed markets. That's why you don't see too much of migration of markets from AM to developed markets. But of course, migrating from frontier to emerging markets is not that difficult as emerging markets to developed markets. But the one that we have highlighted in the middle is the most important requirement of MSCI, which is the size threshold and the liquidity threshold. And once a particular country and its stock exchange meets these requirements, they're already they're automatically included in the index. In the past, of course, we have seen some markets fall out of the emerging market index because they no longer meet those requirements that I just explained. A good case would be Russia. Russia was reclassified from emerging to standalone because of what happened there. And more importantly, Pakistan has been again relegated from emerging market to a frontier market 4 years after it was elevated to an emerging market status because it failed the size and liquidity criteria, even though it meets all the accessibility criteria. We have also seen Argentina again downgraded and removed from emerging market index because the capital flow was not that easy in that market, and Morocco has been downgraded from EM index because it no longer meets the liquidity requirement. So while it is difficult to get into the EM index, you need to stay there by meeting these requirements. And if at any stage these requirements are not met, you can be moved back to the previous classification, which is the frontier markets. Now, obviously, when countries are included in the MSCI Emerging Market Index, it does attract a lot of research coverage from analysts. In fact, we can see that while shortlisting or decision-making or inclusion, we can generally see the number of analyst coverage per stock getting ramped up. We have noticed that for Kuwait, we have noticed that for Qatar and for UAE as well. UAE is a great example where, at the time of shortlist, we noticed 5 analyst coverage per stock, and today it stands at about 10. But these numbers still fall short of other markets. Like, for example, if you look at China, we have 17 analysts covering every stock in China. In India, we have 23 analysts covering every stock, but in Kuwait, we have 4, and Qatar 5, and UAE 10. So we feel that moving forward, this type of analyst coverage is likely to increase as more stocks from GCC get into emerging market index and their weights increase. Already, we have seen some significant analyst coverage for stocks like Saudi Aramco. We have about 15 analysts covering Saudi Aramco, and we have about 13 analysts covering Abu Dhabi Commercial Bank. So we are getting there, but still not there. And we expect that to have an increase in the next 5 years. Just to put contextually the relative sizes of these indices. So we know MSCI World is the largest index in the world. It's about 54 trillion, and it's well dominated by US. And then emerging market index is somewhere in the middle at about 6.5 trillion, dominated by China and Taiwan and India and GCC. And then you have frontier market, which is about 500 billion, actually. So this is the split between these 3 markets. Ever since these markets are included, we will first process of evolution is to have ETFs launched around these countries that get into the MSCI Emerging Market Index. So therefore, we have seen ETFs around Saudi Arabia, UAE, Kuwait, and Qatar, and we have some major ETFs. So that's the first process of evolution. And then you have fund managers and active funds taking a pitch at these markets based on their studies. So we do have fund houses like Invesco, Franklin Templeton, and other domestic fund managers launching ETFs at the moment. But what is very significant to note is the possibility of spotting good compounders and wealth generators for the GCC stocks. In general, emerging markets offer a good opportunity for active managers to generate alpha because of information inefficiency, because of lack of adequate research coverage, and because of the size of these economies, whether it is India, China, they present huge domestic markets, and therefore there is a huge interest in these markets. So even in GCC, we have noticed that there are some names that are consistent compounders over the last 10 to 15 years. We have given some statistics here. For example, if you take First Abu Dhabi Bank, it's compounding at 12% every year for the last 10 years. And we have given some of the wealth creation statistics here. So they look really very interesting to look at. And we also have a list of GCC stocks that are not only consistent compounding, but fastest to wealth creators. So these are maybe they are mid-cap stocks, and therefore their market cap is not as big as the largest wealth creators, but nevertheless we have some significant performance there to notice from a wealth creation point of view. So while ETFs are the first step to the evolutionary process, ultimately fund managers will be more interested in spotting wealth creation opportunities for GCC stocks, which is a huge opportunity set in our view. Now, obviously, GCC also went through this process of inclusions and exclusions. So it's not just a bed of roses. We have some stocks being removed from EM index due to liquidity criteria, but almost all of them happen to be from Saudi Arabia, and we have some stocks included as well. So stocks get in, stocks get out, but at this stage, we can notice that the stocks that are getting in are outnumbered by the stocks that are getting out due to liquidity reasons. The most important aspect, as I said, is to forecast the future. And we have 70 stocks now at a GCC level. So we would like to see who are standing in the line to get included. And we have done the research, and we found out that these companies that you see here have fulfilled already 2 out of the 3 criteria, be it liquidity or free float market cap or whatever. And therefore, one more criteria being met, they'll all be eligible for inclusion. And we see that stocks from Abu Dhabi, Saudi Arabia, Kuwait, Dubai, and Qatar, there are a lot of opportunities for these stocks to come in and increase the opportunity set for the GCC share. So obviously, Saudi Arabia started very small at just 2.6% back in 2019, and today it stands at about 4.2. We noticed the same ramp up for UAE from 0.6 to 1.4. And while for GCC markets, it has always been an uptrend, but for other emerging markets, sometimes we notice a downtrend as well. For example, China came down from 31% to 28% to where it is now. And while India has increased its share from 8.6 to 13.6. So we feel that, in terms of this table, the share of GCC stocks in the overall MSCI Emerging Market Index is bound to go up for the reasons that I have already mentioned. So here is the take based on the research that we have. We have looked at stocks that are very close to fulfilling those 3 criteria. So currently, we have about 7.3% weight, about 70 stocks. We expect that to move to, say, by 2025, to say 95 or 100 stocks based on this study, and the weight will increase from 7.3 to 9%. Also, one other thing that can really cause the change is if for any reason MSCI moves markets like Taiwan from emerging market to developed market, then this weight story can significantly get changed. So obviously, what is driving behind this forecast of both increase in the number of stocks, therefore increase in the weights, are, of course, the macroeconomic strength of GCC markets, strong financial buffers, very large sovereign wealth funds, and some sort of a stable policy. And market stock exchanges and capital market authorities have been relaxing foreign ownership limits and free float adjustments, both in Saudi Arabia as well as in Kuwait. And more importantly, we see that there has been a spurt in IPOs, both in Saudi Arabia as well as Abu Dhabi. And SOEs, state-owned enterprises, privatization will add to the breadth of the market big time. So in terms of the sectoral contribution, as I have highlighted before, the MSCI index itself is heavily in favor of financials and information technology and consumer discretionary, whereas the GCC is extremely heavy on financials with a little bit of materials and communications thrown. So active fund managers can really make use of this difference in sector weights in order to get the sector diversification benefits. And obviously, the call on increase in the weights to about 10% in the next 2 to 3 years is based on several positive assumptions. But however, it is also contingent on capital market reforms being continued and no major geopolitical tension coming and hitting these markets. But at the moment, they all look to be good. So in conclusion, I wanted to focus on why GCC is a very different island of opportunity within the emerging market index. GCC is not a typical emerging market in the sense it represents the high income threshold countries as per the World Bank definition. It has a strong oil-driven economy. Therefore, oil play is at the center of the whole definition. So investors that would like to take advantage of the long-term benefits of a strong oil will naturally see GCC as a great opportunity. And any oil price bonanza will ultimately translate into opportunities for these listed companies and will reflect in their earnings. Secondly, emerging markets tend to be normally very high on debt, but GCC markets are still in a very, very controllable range because of their high financial buffers and the sovereign wealth funds. They don't tap the debt market as much as the typical emerging markets do. And most importantly, from an active fund manager's point of view, GCC doesn't offer any additional currency risk because most of their currencies are pegged to the US dollar, whereas other emerging markets, be it India or China or South Africa, they all come with added currency risk. And post the first inclusion in 2014, we've been seeing very strong inflows of foreign funds into the GCC markets with absolutely no capital controls in play. I think the future also holds very good from this perspective. More importantly, the breadth of the market and the new supply of stocks to the market. The biggest source of those supplies would, of course, be the state-owned entities. Most of the markets have now very focused agenda of privatizing many state-owned entities through the IPO system. Last year, IPO in the MENA region has been the highest in the world. So obviously, IPO is a very important trend to watch, which is behind our assumption that the number of stocks that could represent MSCI Emerging Market Index from GCC can easily cross 100 in the next few years. And therefore, for all these reasons, I believe even though it is classified as an emerging market, it's a separate and interesting island of opportunity for foreign funds and foreign investors to tap. So thank you for a very patient listening, and I'm happy to take questions.
Thank you, Raghu, for the very insightful presentation. It was very interesting to see how GCC markets play within the EM space. We have some interesting questions from our participants, and I'd like to go with the first question. I understand you have touched upon this in some of the slides, but the first question relates to the vision announced by various governments in GCC like Saudi, Kuwait, and UAE, and mega projects that are going on in the region, in Saudi, in Kuwait, especially in the entertainment sector. What do you think are the drivers for the markets? Will these visions translate into any tangible impact?
Yeah, thank you. That's a very interesting question. As I said, from a stock market point of view, privatizing SOEs, state-owned enterprises, are the immediate low-hanging fruits for broad-basing the market. Obviously, all these countries, be it Saudi Arabia or Kuwait or Qatar, they all have a vision. And the vision for the next 5-10 years is what drives their investment pattern. And that's highly contingent on the oil price staying strong. Of course, they have huge financial buffers to keep sustaining this investment trend. But I definitely feel that it will be a combination of FDI, which is foreign direct investment, and foreign portfolio flows, primarily driven by IPOs and triggered by privatization of state-owned enterprises.
Thank you, Ravi. Thank you so much. We have more questions coming in. Although we have spoken a lot about the emerging markets, we have one question on the developed markets, which is interesting, which says that ETFs and passive investing have been gaining traction, especially in the developed markets. What's your take and opinion of whether investors are better off going with passive investments, or do you still feel active investments are yielding better results?
Definitely, as I said, ETFs are the first step when markets get included in index, because for foreign fund managers, these markets are pretty new when they get included. So they would play safe by getting into the ETF side of the story. So ETFs are, of course, very popular globally for institutional asset allocation, and it is definitely growing much, much faster than the active side of it. But as I said before, emerging markets are a very good pasture for alpha generation, and consistent compounding stories are much, much better in emerging markets. So eventually, first few years will attract ETFs, and then the focus will shift to active stock picking in these markets, and that's when people who are on the ground playing the active game can really be very helpful in terms of identifying them. So the first step to the whole process is obviously ETF, but the second and the ultimate step to participate in the wealth creation story should be active management, in my view.
Thank you. That's very interesting to know. We have a couple of questions which have come with regards to inclusions and exclusions from the emerging market index. We had Russia leaving the index some time back, and the question is that if Russia gets included back, will it affect the weightage of the GCC players? And another interesting question related to inclusions is, do you see Oman and Bahrain coming into the index, and do they have anything different to offer for the market?
That's very interesting. Russia, I doubt whether it will make it back to the index because of several complications, including capital controls. So that is not a possibility in my assessment. Oman and Bahrain, maybe, but from a size perspective, it is still small, and therefore we may have to wait for some more large-sized companies to come from these markets to get inclusion. One of the criteria for MSCI is minimum number of companies in the market for inclusion. So Bahrain and Oman has to meet that criteria before it can be considered for inclusion.
Thank you. The other question is related to the weightages of the sectors within the index. We know that financials have been a predominant sector for GCC, unlike the other countries in the EM index. Do you think that the GCC countries on a policy level should focus on diversification? One is the economic diversification that would lead to sectoral diversification within the index. And will that in turn benefit the index as a whole?
I feel that, the reason precisely why foreign fund managers would look at GCC is because of the oil play. And oil play directly translates or reflects into banking and financials to start with. That's why you see that these GCC markets are very heavy intrinsically on the banking sector and the materials and commodities and telecom. I feel that it will remain that way because economic diversification, even though it is highly desirable, is like an elephant in the room. It doesn't move that quickly. So I don't feel that while how much ever the countries would like their economies to be highly diversified away from oil, but it continues to be very oil dependent as at the time as we speak today. So of course they are working very hard to make this diversification happen. We have seen that with Dubai, we have seen that with Bahrain, but markets like Saudi Arabia can be a great example for diversification efforts, but other markets continue to be oil dependent. So I think it's the oil play that will be interesting for foreign fund managers because that's what they don't see in other markets, emerging markets. So I see this more as an opportunity rather than as a threat in terms of the sectoral composition.
There's another interesting question slightly tilted towards the economic side, Raghu, but I think this will also have an impact on the markets. This is about the currency peg in GCC. How long do you think the currency peg can be continued? And in case of continuation or discontinuation, what would be the impact on the markets?
I think currency peg will continue so long as oil is priced in USD. And of course, there are some developments globally in terms of oil trading, especially from Russia and China and India. But USD is a very dominant reserve currency at the moment. And of course, the topic of USD maintaining the reserve status keeps coming up for discussion. But again, I think it's a very long shot as of now. So USD peg to GCC currencies will continue at least for the next 5 years to 10 years in my view, and therefore that risk is almost not there for GCC markets.
Thank you, Raghu. We have one interesting question, especially of the FDI flows into the emerging markets. With all the geopolitical changes happening and a threat of looming recession, high interest rates, how do you see all these factors playing into the FDI inflows into emerging markets and also the fund inflows into the respective indices and the markets?
Yeah, emerging markets are a very good pasture for FDIs. We have seen that for China and we have seen that for India. Obviously, that story will continue if we don't have any major geopolitical upsets. But what is very interesting and relevant for capital markets is the foreign fund flows into the capital markets. That will be dependent on the number of stocks and weights that are represented in the index. And that's the whole story that we are presenting here. If GCC markets cross the 10% threshold and 100 stocks represented in the index, then you will see a lot of fund flow happening towards the GCC markets. So that's very interesting, but they are very parallel tracks. FDI and foreign fund flows, and therefore one is highly dependent on long-term infrastructure investing type of a story. The other one is probably medium to short-term stock market story.
Thank you. A couple of more interesting questions coming in, mostly related to the upgrade of the existing indices in the emerging markets, especially some of the GCC ones into developing markets. Do you see it happening in some years down the line? Or do you see the developing markets or emerging markets, which one is going to run the race? Do you think emerging markets will outperform or the developed markets will be outperforming?
From a performance point of view, I think it will all have its own individual cycles, and index is a very complex thing. We have more than 30 countries represented in the MSCI Emerging Market Index. Each country has their own cycle of performance, and that's what will get finally reflected at a composite level. So, that's a very hard question to answer in terms of predicting the performance of emerging markets going forward. That's why there is a big requirement to do some full-fledged research, to take bets on countries and stocks, so that we can avoid some traditional choices that can be avoided and focus on long-term compounders. And that's the whole reason why active management is suggested compared to passive management. With regard to the question whether GCC will ever move from emerging markets to developed markets, I think it's too early a question, because they've just become part of the emerging market index. So they will remain there for some time. It is the climb or the jump from emerging markets to developed markets is a huge one. So that will be a very, very difficult barrier to cross, especially from a market accessibility parameters that MSCI has.
Thank you, Raghu. I think we're coming towards the last question, which is quite interesting. Over the years, we have seen Saudi Arabia gaining a lot of weight within the GCC exposure in the EM index. Do you think that investors should consider taking exposure to Saudi alone, or will they be better off tapping all the opportunities within the GCC EM?
I think just focusing on Saudi may not be a good idea, because even though Saudi constitutes nearly half of the GCC, there is this other half that also presents some very interesting opportunity. All the four markets that we are talking about are very, very high on capital market reforms, focused on IPOs. Of course, Saudi Arabia has been very red hot from an IPO perspective, UAE to some extent, but Kuwait and Qatar, not much of IPOs as we speak now. But the banking opportunities and financial sector is equally good in all these countries. Obviously, being a very large market with outsized share of the weights, Saudi will obviously be the first point of stop for foreign investors. But if I were in their shoes, I would look at all the four markets with equal interest.
Thank you. Thank you so much, Raghu. Before I leave it to you for the closing remarks, I just wanted to let our participants know that if they have any questions regarding the topic or any other areas of research for GCC, they can write to us and we will be very happy to respond. Over to you, Raghu, for the closing remarks.
Thank you. Thank you. I mean, I enjoyed really the questions. They were quite good. And this is a very research-based presentation, and we have worked really hard to get some of the framework, and we keep consistently coming and sharing our knowledge to our investors and stakeholders, and we'll keep going in that path as one of the leading investment asset management names in the region. Thank you very much.